Hey everyone, thanks for attending Siller & Cohen's Wealth Unpacked series. I'm Brian Gloria here with Josh Marriott. We're both private wealth advisors at Siller & Cohen. In this video, we're going to cover part one of 3 sessions on 529 plans. So let's just jump right in. Josh, why 529s?
Thanks, Brian. And there are several reasons, but let's start with a benefit that I think is underrated. And it's the idea of having a dedicated investment account that's earmarked for education funding rather than commingling it with your other investments. So you can make contributions to this account, track your progress against your goals along the way, and increase your funding if you feel like you're behind, or scale back on your funding if you think you're a little bit ahead of schedule.
Yeah, that's a great idea. So what about some of the tax advantages?
So the tax advantage nature of 529 plans is the most powerful benefit. Let's be clear. Because although the bucketing approach is nice, that's more of a psychological benefit, right? And you can make the argument initially that you could do the same thing with a savings account or a dedicated taxable investment account. But 529 plans have these key advantages, and one being tax deferral. So similar to an IRA, you don't pay tax, you don't pick up capital gains, interest, dividends each year on your tax returns. You don't have that additional expense along the way. So that allows the compounding to work for you. That's one. Two, there's tax-free growth. No tax on the distributions if the distributions are used for qualified education expenses. So if you compare it to an IRA, you make a distribution from an IRA, you have to pick that up as ordinary income tax. If you take a distribution or make a withdrawal from a taxable investment account, any of that gain will be taxed at capital gains rates. Not the case with a 529 plan. And then the final in some states is a state income tax deduction. So in the state of New York, for instance, you can get a deduction of up to $10,000 per couple, $5,000 per person. And in Connecticut, again, $5,000 per person, $10,000 per couple. And if you exceed $10,000 in any given year, you can actually carry that forward. Pretty hefty tax benefits that really you can really take advantage of with a 529 plan.
Yeah, I mean, that all sounds great. I think this is one of the areas you have a pretty powerful illustration that I think really kind of hammers home that point.
Yeah, let me share my screen. Just let me know when you can see it.
Yep, you're good.
So in this example, we're going to be looking at the power of tax deferral. And the 529 plan is going to be growing at 6% rate of return, while the taxable account's growing at 5% rate of return. That difference is because there's a 1% tax drag in our hypothetical example on the taxable account. So if we fund this account every year for 18 years at $10,000 per year, in both scenarios, you have $180,000 of contributions. But the difference you're going to have is the 529 plan is growing gross of income taxes, and that's going to grow at the end of our example to be $327,000 versus the taxable account growing to $295,000. That's a difference of $32,000. And that's just the tax deferral part of this. When we look at the power of tax-free distributions on qualified education expenses, you're gonna pick up about $35,000 of capital gains tax on a taxable account, which changes the math a bit. $295,000 now only becomes $260,000. So the difference between 529 and taxable account is now about $66,800.
Wow, that's basically a full year of tuition, depending on where you go.
Yeah, absolutely. The power of both of those together is pretty significant. And if you're in a state that allows an income tax deduction on the way in, the 529 plan gets an additional leg up of roughly $15,000, which takes 327 up to 343, and makes the difference between the two strategies $82,000.
Wow. Yeah, I think that was really, helpful to kind of just see it laid out like that. So as far as some contribution limits, as we go through that, I know people are wondering, might be familiar with IRAs, 401ks have certain limits. Yeah. Based on the state you're in, for example, obviously like New York has $520,000 contribution limit. Connecticut's is $300,000. Doesn't include growth, just includes, the amount contributed.
Yeah.
Those are pretty high, so really shouldn't be an issue for most people. But can you talk a little bit about the annual exclusion limits?
Yes. Gifts made to 529 plans that benefit someone other than yourself, so child, grandchild, are considered to be completed gifts for estate planning purposes. This means that although you are the owner of the 529 plan account, the funds are technically outside of your taxable estate. So whenever you're making a gift that's leaving your estate, you need to be aware of annual exclusion gift limits. And there are some exceptions along the way, but largely you need to be aware of the annual exclusion gift limits. And currently the limit is $16,000 per person, right? So $32,000 per couple for any one beneficiary. So you can have multiple beneficiaries receiving that $32,000, but it's 16 per person, 32 per couple. To the extent you exceed that $16,000 per person, you'll be reducing your lifetime exemption dollar for dollar. This leads me to a very unique exception that 529 plans have. You have the ability to front load 5 years worth of gifts to a 529 plan without impacting your lifetime exemption. And I'm gonna, if it's okay with you, I'm gonna bring up slides again. So the concept I just addressed, 16,000 for a wife, a husband, 32,000 per year. That's typically would be spread out over the course of 5 years, totaling $160,000, right? But with a 529 plan, you're allowed to accelerate those gifts into 1 year, the first year, for instance, to get the full 160 in year one. Why would you do that, right? The reason is to get the power of compounding going sooner, get the money working for you in the market and earning and growing sooner, right? To get a jump start. And we're going to illustrate that. We're going to have a scenario that looks at just giving annual gifts for 5 years and a scenario that looks at front loading with the same rate of return, 6% in both scenarios. And look at what the difference is. So in both scenarios, you're contributing $160,000. One is over 5 years, one is lump sum. At the end of 18 years, the difference is about $49,000 between front loading versus spreading out those gifts over 5 years. So, and that's in favor of front loading, really showing that the compounding really got started early and got to work sooner and created that larger value at the end of the day.
Awesome. Yeah, thanks for sharing that. That's really helpful. All right, so listen, we're gonna start wrapping up this session here. If you're curious about how much you can afford to save or how much you should be saving, please feel free to reach out to Josh or myself. In our next session, among other things, we're going to cover some FAQs like, what happens if your child doesn't go to college or gets a scholarship? Can you fund a plan for an unborn child? So we'll be touching on some of those and any other questions that might come up in the meantime. So thanks for listening in to Siller & Cohen's Wealth Unpacked podcast. Feel free to visit our website for more insights and contact me or Josh directly if you have any other topic suggestions or any feedback. We'd love to hear it.
Yeah, absolutely.
Great. Thanks, everybody.
Thanks. Bye.